Okay, let's just jump right in. We're looking at a company you definitely know, a real household name that Wall Street has basically thrown in the penalty box. Today, we're going to make the case for why the market has Clorox completely, totally wrong.
And hey, that's not just my opinion. That's the core of the analysis we're breaking down here. It's a pretty bold claim, right? So let's unpack exactly what's behind it.
So, here it is, the big idea right up front, no waiting. The whole thesis is that this company, which is an absolute fortress of brands, is being treated like its best days are long gone. And the opportunity for you, according to this analysis, it's a potential upside of anywhere from 20 to 60%. Yeah, that's why this matters.
So you have to ask, how did we even get here? How does a company that's in practically every home in the country become so misunderstood by the market? Let's dig into what seems to be Wall Street's big mistake.
The reason for this mispricing really comes down to three big negative stories that have kind of stuck to the company like glue. To really see the opportunity, we first have to tackle each one of these market myths head-on.
First up is the big one, the pandemic. We all remember it, right? Empty shelves, everyone's stocking up on wipes. The market seems to think Clorox is still reeling from that boom and bust cycle. But is that what's really going on?
Now, this is where it gets really interesting when you see them side by side. The myth is that the 2020 sales peak was a total fluke, and the drop that came after proves the company's in trouble. But the reality is, well, it's a lot less dramatic. That crazy surge was just a temporary distortion, and now sales have simply settled back to their normal, long-term trend. In other words, the pandemic hangover is officially over.
The second myth is all about profitability. And look, there's no doubt inflation hit companies hard. The story on the street is that Clorox's margins were basically wrecked for good in the process.
But again, that narrative is missing the full picture. Yes, cost for materials and shipping went through the roof, but this wasn't some permanent new reality for the business. It was a temporary shock. The truth is that margins are already bouncing back, thanks to some smart price increases and new efficiencies. The key insight here is that the inflation crisis actually forced them to become a leaner, stronger company.
And finally, the most recent headline grabber, that ransomware attack back in 2023. The market treated this like a huge red flag, a sign that the company was vulnerable and didn't have its act together.
But let's just apply a quick reality check here. The narrative is all about vulnerability. The reality? This was a one-time operational disruption. Was it painful? Oh, for sure. But it's over. The problem is solved, their systems are stronger now, and the business has moved on. The market is basically treating an old headline like it's a current crisis.
Okay, so we've debunked the negative stories. Now let's flip the script and focus on what the market is totally sleeping on, the powerful, durable strengths that are the real foundation of this company.
And this slide right here, this is the company's real superpower. This isn't just a bleach company. I mean, just look at this portfolio. Glad Bags, Kingsford Charcoal, Burt's Bees, Brita Filters, Hidden Valley Ranch. Come on. These are all brands that lead their categories, that people buy without a second thought, recession or not. It is a true fortress of brands.
And on top of those amazing brands, you have this incredible track record of rewarding shareholders. Clorox is a Dividend Aristocrat. That's a super exclusive club of companies, and it means they haven't just paid a dividend, they've increased it for over 46 years straight. Think about that.
And just look at the dividend yield today. At over 4.6%, it's not just competitive, it's flat out superior. It's higher than its main rivals, and get this, it's even higher than the 10-year Treasury yield. That means you're getting paid more to own this premium company than you are to own a government bond. For anyone looking for income, that is a massive signal.
So the brands are strong, the dividend is a rock star. But what about the price? Let's get into the hard data that this whole argument is built on. This is where the story gets really, really compelling.
This table really says it all. We're looking at the forward price-to-earnings ratio, which is just a simple way to measure how much you're paying for $1 of the company's future profits. Right now, you're paying about 16.5 times for Clorox, but its competitors, they trade for over 20 times. And Clorox itself historically trades for 20 to 25 times earnings. It is being priced like a problem child, not the premium company it actually is.
So what does a return to normal actually look like? Well, this slide maps it out. Even a conservative return to just an 18 times multiple suggests a higher stock price. If it gets back to its own historical average, around 20 times, we're in that middle range, and if the market once again gives it the premium valuation it deserves, well, that's the path to that 20 to 60% upside we mentioned right at the beginning.
This brings us to the final piece of the puzzle.
If the numbers are so clear, why in the world does this opportunity exist in the first place? Well, the answer lies in simple market psychology.
Here's exactly why Wall Street is getting it wrong. First, they are anchored to the memory of that wild pandemic boom and bust cycle. Second, recency bias makes the cyber attack and the margin pressures feel way more important than they actually are today. And finally, you've got shiny object bias. Let's be real. In a market obsessed with AI, a boring, steady company like Clorox just gets ignored. It's these psychological biases that create the mispricing and the opportunity.
So that leaves us with this one final crucial question. After looking at all the facts, the powerhouse brands, the recovering margins, the incredible dividend history, and the valuation, is this a fundamentally broken business, or is it simply a solid business with a temporarily broken valuation? The analysis we've covered today argues pretty strongly that it's the latter.